everybody. Welcome back to Attitudes with Andy, but this time we're on tour in England. Thank you so much for tuning in. This is a place where we get to learn and grow together every single week from incredible guests. And today we have a very special guest to teach us all about investing, but in particular funds. If you don't know what that is, then this is for you. And we're going to be breaking down what funds are, how to invest in them, how to find good ones, and so much more. So today we have Mr. John Chatfeild-Roberts, who is a fund manager for Jupiter. He's been in the industry for 30 years and 20 years with Jupiter Management Firm. So we have got a wealth of knowledge. Him and his team manage about £7 billion. So that could be around $14 billion. But don't take my word on that translations. But yes, without further ado, welcome, John, to the podcast.
Thank you very much for asking me.
Of course. All right, so the first thing we want to start with is the little disclaimer that you would like to say.
Yes. Well, I'm a fund manager in London, but my regulatory permissions don't allow me to give any individual financial advice to anybody. Obviously, I run money for a lot of people I guess it's in the tens, if not hundreds of thousands of people. But so none of what I say is to be construed as personal financial advice. I'm not giving any recommendations about individual investments. So I think the two words are caveat emptor. You need to use your brains when you're investing.
Okay.
Your own brains.
Cool. So what John's saying is this is just for educational purposes only and is not financial advice.
Correct.
Okay. First question I have for you is, what is a fund?
What is a fund? Okay, so I will start one stage back. A fund is commingled investment, i.e. lots of people putting all their money into a single pot to have it invested. But the principle is that if you, as an individual, buy one share in a company, that company can go bust, and your investment just disappears. So as an investor, perhaps you ought to have a number of different companies that you've invested in, say 5, 10, 15, 20, statistically gives you a reasonable shot of not being held below the waterline by people going bust. But of course, to buy 20 individual companies actually is a bit more work. I mean, you might have one brilliant idea, but to have 20 brilliant ideas, that's, you actually need to do your own day job as well. And I'm assuming here that the people listening are not actually investors themselves. And so how do you do that in a time-efficient manner? Well, one of the ways of doing that is to put your money into a fund where somebody else, in this case me, a fund manager, chooses investments for you, and that fund is lots of people's money put into that pot, and the fund manager goes off and invests it for them.
Okay. That obviously sounds very ideal. We're saving time. We might be making more money compared to if we were doing it ourselves. What's kind of the difference between just putting it in like a basic index fund versus a managed fund?
Okay, an actively managed fund.
Yeah.
Yeah, okay. So an index fund literally copies, as far as it can, the index it's trying to replicate. In the UK over here, you talk about the FTSE 100 index. In America, perhaps you talk about the S&P 500. In Australia, I actually don't know which index you would copy. But the idea is literally just to take no active view about what's good and what's bad. And it's based on the idea that people are just not going to be better than the index. We can talk about that later. An actively managed fund, on the other hand, has an individual or a team of individuals choosing investments because they think those companies are good and not bothering to invest in companies which they think are bad. That's the difference.
Okay, so it's a lot more like, let's actually analyse these instead of let's just copy the top 200.
Oh yeah, no, I mean, an index tracker does not do any analysis at all. It just knows what's, I say it knows, the people behind it know what's in the index, and they literally just try as far as they can to copy the index.
Okay, cool. So some of the information that I've read in like finance books and stuff kind of paint funds sometimes in a bad light, because they'll be like, there's high fees, it's really hard to actually outdo a basic index fund, all of that. What are your opinions on that, and do you think it's true?
Okay, so the first thing I have to say is that I work for a house, Jupiter, which is an active management house, and we believe that active management is the best way of doing it. But, you know, there are many, many different views out there, and that just happens to be our view. The downsides, as you correctly say, are actively managed funds are more expensive, and it depends on what statistics you look at, but many active managers fail to outperform the index. The thing is that if you think about life, I mean, in my industry, in our industry, we talk about quartiles. So you've got top quartile and you've got bottom quartile and the two in between. Everybody is trying to be top quartile, i.e. above average and significantly above average. But if you think about, you know, just statistically, not everybody can be top quartile, because you've looked at the population and a quarter of it's going to be top. And the difficulty is that over time, people find it awfully hard to stay at the top. The thing is that in life there are outstanding individuals in all areas, and finance is no different. But, you know, if you think about going to school, there were teachers who taught you who you had no idea what they were telling you. It just sort of, you sat there for an hour in your lesson and you came out of it none the wiser. So there are bad teachers, there are bad fund managers. And as it happens, my job is to try and identify the good ones, because I believe that there are a small number of good fund managers out there which you can identify over time. It takes quite a lot of time and experience to do that, and those ones do bring home the bacon. That's my belief. The other thing to say is that indices are, I mean, they are so, it almost blows my brains actually. What you're doing as an index tracking investor is literally you're just accepting what is going on out there. You're not trying to invest in the future. You're just basically investing in what's done well so far. And the way indices are put together, the biggest companies tend to be the ones that have done well over a long period of time. Who's to say whether that's going to carry on in the future? Nobody.
Okay, so if people listen to this and they're like, okay, cool, I want to pick the good funds, what are some things that you should kind of look for when you're trying to choose what funds? Because there's a lot of funds out there and I would be bewildered, you know?
It is, I mean, it is quite hard. I will absolutely, I won't deny that. And I've spent a working lifetime trying to do just that. And I get it wrong, my team gets it wrong, you know, I was going to say often, you know, nobody is perfect and we get things wrong from time to time. What are you looking for? Well, we look for individuals, sometimes within teams, but what we're looking for is outstanding individuals. And you can identify that through their performance track records, but it helps if you can meet them. And in my world, we do get to meet a lot of these people as an individual investor. On the outside, that is more difficult, and I honestly don't know how you sort of get around that. Some people put up videos, but it's not the same as seeing somebody face to face. So we are looking for competitive individuals, so people who have demonstrated competitive instincts. So when they were at school, perhaps they, I don't know, were sporty or something like that, but people who actually want to win. Because if you're so laid back that it doesn't matter, you're probably not going to do too well at fund management, because, you know, it's a dog-eat-dog world out there. We want workaholics, to be frank. Really? Absolutely. Yeah, no, because it's, I mean, you know, nothing gets given to you on a plate. And again, we don't want people who are just going to sort of float with the tide. We want people who are really going to work at it. We want people who are questioning. I don't know if you've met people who, when you talk to them, they're constantly asking you questions. So the conversation is you answering the questions that they've put to you. And those sort of people are really interesting at all sorts of levels, but they also tend to make quite good investors because they're constantly trying to make sense of the world around them. So those would be 3 things I'd be looking for.
Okay, so you're more focused on the actual individual person who's managing the money. I mean, that makes sense, but I wasn't expecting that answer.
No? Okay. I did also mention the track record. So I don't know what it's like in Australia, but certainly over here in the UK, all the adverts have to say, in the same size font as the advert, general thing, past performance is no guide to the future. And every piece of marketing material from any fund management company has that on it. It's a bit more nuanced than that. I mean, if you were going to try and find an accountant, you might ask a friend of yours, do you have an accountant? Are they any good? And so people do talk to each other, and so past performance of what people have done in the past can tell you something about how they might do in the future. But the interesting thing to us is not just a graph going upwards, but how did they do in a specified period of time when a particular thing was going on. So, I mean, it's almost ancient history now, but if you go back to 1998, 2000, that was the dot-com bubble. And things got thoroughly out of hand, and companies that were worth absolutely nothing basically went to the moon. So bubbles over the years can have happened. But what's the interesting thing here is, if you found a fund manager who did really well during that period of time, you probably might identify them as being a bit flaky. I was going to say, perhaps they are technology investors, but perhaps they just got a bit too caught up in it. And somebody who did really badly during that period of time, when lots of really good companies, share prices just went down and down and down because people just weren't interested. Somebody who performed really badly during that period of time, you might identify as a good fundamental investor who was just, the market was going up in a bubble and they were sticking to their knitting. And when the bubble burst,
sticking to their knitting.
Well, indeed, but that's just an English phrase, isn't it? But when that bubble burst, those people who'd been doing really badly suddenly started doing really well, because people suddenly realised that this completely idiotic bubble was disappearing, and they really needed actually to be invested in good, solid companies, well-financed companies that were going to be around in 10, 15, 20, 30 years' time, and were making money rather than just being a flash in the pan.
Okay, so more like long-term thinkers as well, not just like the quick.
Oh yeah, no. I mean, if you went down to our fund management floor, lots of people expect to hear lots of shouting and dealing going on. It feels more like a library.
Yeah, it's so calm. That's so true.
So there you go.
Oh, yeah, I remember that. Okay, cool. What about fees? Because I've heard that sometimes it can look like you're earning a lot of money from your fund, but then if you add up kind of the fees that are on it, sometimes that can eat away your profits.
Well, there's no doubt that if you got completely free investment management, whether it was passive or active, you would make more money than you did if there was a fee attached.
Yeah.
And the bigger the fee, the bigger the drag. As an active fund manager, the important thing is how much value is being added after fees. So as a fund manager, you know that you are charging fees, and you've got to do better, both than the market, but having also then taken account of your fees. In England, and I assume it's the same in Australia, the price of a fund incorporates the fee. So you'll have a fact sheet which will tell you all the details about the fund, but on a daily basis, each fund will have a price, and that price includes the fee that you've been charged. So it shouldn't be difficult to work out how much you're worth, but it can be less easy to see how much you've paid in fees. Over here, there are heaps and heaps of regulations to make it easier for people to work out how much they've been charged. And, it's rather like, again, I don't know what the corollary is in Australia, but like shopping in Waitrose or Marks and Spencer's versus Aldi or Lidl. For our Australian listeners, Aldi and Lidl are Pilot High, Sell It Cheap supermarkets, and Marks and Spencer and Waitrose tend to be...
they're like the IGA of Australia.
Well, there you go. And arguably the quality is better.
Yeah, okay.
So you pays your money and you takes your choice, really.
Okay. So is there any kind of like ball point to look at, like a 1% fee, 2%, 3%? What would be like, you would think that's outrageous?
Well, things have changed over time, but 1% fee over here for a retail investor would be, I guess, sort of average. We have things called fund supermarkets over here, and they tend to charge a platform fee. So you log on to your fund supermarket and you can buy funds from all over the place. But you would probably find you're paying a fee of 25 basis points, 0.25%, on top of the fund fees. I mean, anything much more than, 2% definitely would be a lot, and 3% would be an awful lot. Okay. I would have thought. But different markets have different norms.
True. Okay. I'm learning lots. Okay, we talked about the index fund before. Did you want to speak about that again? Because you said we'll come back to it.
Oh, yeah.
I wasn't sure if there was something you wanted to touch on.
Well, merely on index funds.
Yeah.
Index funds also have fees. They tend to be lower. But of course, an index fund has two problems. Firstly, it's got the drag of its fees. And secondly, it's very, very difficult to exactly replicate an index. And take the S&P 500, it's got 500 stocks in it. So you can have a full replication, which means that your fund has to have every single stock in it, or you can have partial replication, in which case you're using a statistical methodology to try and track that index. Indices change over time. Companies go bust. That's easy because your shares are worthless. Companies get taken out of the index. Companies get put in the index. And each time that happens, as an index tracker, you've got to do something about it. So if a company gets put in the index, you've got to go and buy the shares. And something will have been taken out, so you've got to sell those ones. And there is an element of being front-run by the index provider. Front-run, I won't try and explain it, but essentially, the index provider says, company X is out and company Y is in, and then everybody has to sell company X, so that price will get depressed more than it perhaps should have been, and company Y is in, so that everybody tries to buy it, and so that you'll probably find you're paying more than you should have done, and once everybody's bought it, its share price will drop back to where it should have been. So there are sort of technical things that are problematic with index funds.
Yeah, no, that makes so much sense. I'm glad we've spoken about that, because it feels like every second investment book is like, just buy an index fund, because there's some like really high statistic of like 97% of investors can't outdo a basic index fund or something like that. It's like a really high statistic, but don't
97% sounds quite high to me.
It does.
The other thing about index funds is how many indices are out there. Do you know?
When you mean indices, what do you mean by that?
It's plural of index.
Okay, cool. Just checking.
That's right. So,
asking for a friend.
Yeah, no, absolutely. Phone a friend. So you want to track an index. Which index do you want to track? Well, there are tens of thousands of indices out there. And that is a problem in itself, because you can't track every single index out there.
No.
So you're making an active choice when you choose an index tracker as to which index you're tracking.
Yeah. Okay.
You can't, I mean, basically what I'm saying is investors cannot absolve themselves of responsibility.
I like it. Okay, so just going back to the funds, we're kind of jumping, But so when looking at a fund, we want to take into consideration the individual person, the previous track record, and maybe some fees as well. What about how many like companies they're invested in? Is that something good to look for?
The great thing about investment is there's no one right answer, and different people get success, have success in different, choosing different ways to invest. So, in terms of numbers of stocks, there are rules, certainly over here, about the minimum number of stocks you have to invest in.
Oh, really?
Well, in a unit trust in this country, you cannot have any holding more than 10% of the fund. So that's the first restriction.
Wait, hang on, sorry. Oh, as in like.
So if you own a company in a fund, as the fund manager, you can't the fund cannot have more than 10% of its overall money in that single investment.
Oh.
Secondly, it's the top 5 holdings of the fund cannot make up more than 40% of the investment. So you've got these restrictions, and what it really means is that most people run with funds that have at least 20 stocks in them. But I've seen funds with a couple of 100, 300 stocks.
Wow.
Particularly if it's a very large fund and it's invested in smaller companies, literally you've got too much money, and you just can't find the liquidity to buy all these companies. So your list gets longer. But if you're trying to play a theme, say you're trying to play, I don't know, the rise of currently AI is the sort of the buzzword.
Yeah.
You might find you have to buy 10 companies to play that theme, because you don't know which one's actually going to be the winner. Right now, it seems like Company A, but it keeps on going, and then Company A just disappears because it's been had its lunch eaten by Company Z.
Yeah, it's such early days of AI. Okay, interesting. So, wow, I had a question. Hang on. Wait, it was a good question.
About AI?
No. It was about investing. It was about funds. Hang on. Okay. Damn it. It was a really good one. And then I got distracted by AI. Okay. No, that's all right. So what other factors are important to look for in a fund? So we have like personality, fees, history, and how many.
So, well, you've got to decide where you want to invest. And by that I mean geographically. So do you want to have money invested in China, for instance? Politically, perhaps a bit more problematical these days. I think I would argue that when you've got money invested in China, you might be worried about whether you actually might get your money back at all. I don't know. I mean, that's a Western view. I guess the Communist Party of China might give a different slant on that. Russian stocks, we made quite a lot of money out of Russian stocks in the 2000s. I mean, now you're not allowed to own Russian stocks over in the West, certainly in this country.
Oh, I didn't know that.
Yeah, no. Well, I mean, there's a war on. I mean, it would be like investing in Nazi Germany in the Second World War. You wouldn't do it, would you? So where do you invest? Geographically, so Australia, America, and then the geographical base of a company doesn't necessarily mean that's where its operations are. So you've got, of course I'm not allowed to talk about individual stocks at all, but say, there are big American companies or big European companies that have operations all over the world. So you've got to choose that. And then do you want to invest in sectors? So do you want to invest in the oil and gas sector? Some people would say, absolutely, it's the work of the devil, because oil and gas has been heating up the planet. And other people might say, well, actually, our civilization will collapse if we don't invest in oil and gas, because although renewables are coming along and nuclear's around, actually there just isn't enough of this stuff. There are huge questions to be answered and things to be looked at. So you've got to make those choices as well. Some people get an investment advisor involved, and there are good investment advisors out there. But I always remember being told early on in my career, whenever anybody tells you something, you've got to realise that they're coming at it from a particular angle, and you've got to work out what their angle is. So if you get an investment advisor, certainly over here 30 years ago, investment advisors were paid on commission by individual companies, and you used to have tied advisors who were paid by a particular company, and then there were others who were paid by lots of them. So there were lots of good tied investment advisors, but you had to know that you were being restricted to buying products from one company.
So they'd get commission for passing on a client to invest in a...
Yeah. So salesperson might be a better description in some ways.
Is that still the case now? Is that allowed?
Over here, I don't think tied agents have been around for 20 years, I would have thought. I'm not really sure.
Oh, okay.
But again, in Australia, I don't know what the form is there.
In Australia, I believe financial advisors or wealth investment people they're not allowed to be tied to any.
Right, yeah.
I think so. That's what a financial advisor told me anyway. Maybe that's not true. Okay, perfect. So if people are listening to this and they're like, okay, cool, I feel a little bit more confident in what a fund is, what I'm kind of looking for, but I want to learn more, what are some places where people might educate themselves a bit more?
Okay, well, I think I'm going to allow myself one sales pitch.
Okay, yes.
Which is that I did write a book about this.
Yes, you did.
About 15 years ago. It's called Fundology. It's still available, certainly on amazon.co.uk. So it's been in print for 15 years. And it does go through all the basics of how funds work and some of the things to look out for. But, in this day and age, there's a plethora of information out there. If you're really interested, you should read widely about investment. Most of it's common sense. It doesn't need to be lots of formulae about how to invest. You just need to, if something looks too good to be true, it probably is too good to be true. If you talk to Australians of a certain vintage and say the word Poseidon, have you ever heard of Poseidon?
No, what does that mean?
I think there was whether it was oil and gas or whether it was just mining generally, there was a bubble in the very early 1970s, and Poseidon was the poster child of this particular bubble. I think it went bust. And so people of a certain vintage in Australia, as soon as you say Poseidon, they go, oh yeah, okay. So caveat emptor is a really good thing to remember in the world. Do you know what the definition of a mine is?
No.
It's a joke definition, but there is an element of truth. It's a big hole in the ground with a liar on top.
Savage.
Yeah, absolutely. So, that obviously there are plenty of perfectly good mining companies out there, but where there's money, money attracts clever people, and it also attracts shysters. And that's always been the way. So if you go and read Anthony Trollope's book, The Way We Live Now, which was written in 1860, I think it was 1860, it was around about then, a Victorian. It's a great yarn, and there's a guy called Melmotte in it who is getting money from people in England to buy to build a transcontinental railway in America, and of course it's complete fraud. And so every generation has these things going on. America had Enron 10 or 15 years ago now, which was, have you heard of Enron? No, you're a bit too young. But so
all the listeners are probably like, I don't know that either.
That was a big fraud. There's a court case going on in Germany right now about a company called Wirecard, which got into the DAX 30, I think it was, and allegedly that was a fraud. I have to say allegedly. The shares went to zero, but that was the court case is going on right now. but as an investor, you lost all your money if you had shares in that. So,
is there a way to kind of, what happens if you are investing in a fund and turns out the fund is fraudulent all the numbers, it is fake? Is that possible?
It's very, very rare.
Okay.
There was one in America, a hedge fund, 10, 15 years ago now. I'm struggling to remember its name, but there we go. Funds are, across the world, highly, highly regulated. Individual companies within a fund might go bust, but because you've got the diversification, it shouldn't really be a problem. So I think generally speaking, people can trust funds. Whether they outperform or underperform is a different matter. But the chances of funds going bust are, generally speaking, very, very small.
Okay, cool. And say, because like a lot of my listeners are in their early
that's
20s.
regulated funds, by the way.
Oh, regulated funds. Okay.
Yeah.
So there's regulated funds and non-regulated funds?
Well, again, I don't know the Australian scene.
Yeah.
But there are basically less regulated funds in sort of offshore jurisdictions. I don't know what. I mean, in this country, if there were funds in, say, the Cayman Islands or something like that, you're probably fine. But they tend to be less regulated. So I would imagine in Australia, Australian funds are regulated by whatever the Australian regulator's called. Over here, it's the Financial Conduct Authority.
Okay.
But your listeners, you were saying, are in their 20s.
Yes, so listeners, early 20s, mid-20s, some late teenagers. So, we don't have an abundance of money yet. So would people focus on kind of just finding a fund that they think is a good fit for them? Or do you think like a few funds to invest in? Asking for a friend, because I know this isn't financial advice.
I think the most important thing is, in your very early days, to get the saving habit. I really do. So saving $25 a month or $50 a month. I remember to say dollars, not pounds. But the compounding effect of putting money aside, putting it to work in a fund, and then leaving it over years and years and years it's incredible. This may sound bizarre, but I was looking at my season ticket the other day. Season ticket for travelling to work, which is quite expensive these days. Over 33 years I've had a season ticket. The compound rate of that, the rise of that season ticket, it was roughly £3,300. It's now £11,100.
A year?
But the compound rate is only 3.6%. So you don't need very much but if you just keep investing and it keeps going up, it can be very powerful. Yeah. So in answer to your question, should you choose one fund or several? I think to start with, you'd probably only choose one because you probably wouldn't have enough money to have more than one.
Yeah.
Perhaps when you've got a little bit more money, branch out 2 or 3, but I wouldn't overdo it.
Keep it simple. Okay, we like simplicity here. So, is there usually a minimum investment amount for funds?
Yep.
And is it quite reasonable, or?
Again, I can only talk about the UK market, but here, normally £50 a month if you're doing a monthly saving scheme. Yeah.
Well, you can do that.
Yeah. Or as a lump sum, I think sometimes £500, sometimes £1,000.
Yeah.
So I mean, you don't have to be as rich as Croesus to get on the ladder.
That's awesome.
But I think it's a state of mind actually in some ways.
What to be like? I'm an investor.
Well,
or the process of saving.
It's one of those things that most people think, oh gosh, this is so difficult, I'll do it another day. Because cold towel around the head, I've got to think, and people don't really like thinking. But actually, once you've made that leap and decided, well, I'm actually going to get on and do this, I think it's much easier because you've jumped that mental hurdle.
I like it. Okay, so we like to end every episode with the quick 5. It actually won't really have too much to do with funds, but before we go into that, is there anything else you'd like to sprinkle in for the listeners?
No, I think I've said enough.
Yeah, I think you've hit it all. It's great. Okay, and I'll put in the show notes about your book and stuff so people can find it if they want to read it. I have it on my Kindle. Okay, so the past 5. I'm just going to ask you 5 questions and you just need to answer it, whatever comes to mind first. Okay, first question I have for you. Do you agree or disagree with the statement, money buys happiness, and why or why not?
No, I don't agree with the statement, but things you can do with money can alter how happy you are or not. So with money, if you give it away, there's good research from Canadian. It's not a quick fire, I'm sorry, but
no, it's okay.
Yeah, so there's Canadian research. I can't remember the name of the 2 authors, but they've written a book called Happy Money, and they've discovered that if you give money away, that makes you happy, as long as you think you've made a difference to whatever it is you're giving money to. If you buy experiences rather than things, that tends to make you happier. If you pay for those experiences in advance, by the time you come to, say it's a holiday, if you pay for it in advance, 3 months in advance, by the time you get there, your brain's telling you it's free. If you share it with friends, that is better still. So in some ways, money can buy you happiness, but money can also create significant problems for people, and the evidence is all around us.
Yeah, because if you don't have enough, then it can be so stressful as well.
Nobody ever has enough. I mean, Homo economicus always wants more. That's one of the basic principles of economics. If you've got absolutely no money at all, that potentially is a problem, although some people can manage without.
Well, I mean, like, if you don't have enough to, if you're struggling to pay your rent every single week and put food on the table.
Yeah, I would agree there. But as soon as you can do that, some people would say, oh, well, I can't go for my second holiday or buy my third home. Or
That's so true. Have you ever been caught up in that trap?
I don't think so.
Okay. Yeah, I feel like you've always been so wise with your money. So wise with your money. That's actually a really good point that we always think we don't have enough. Yeah, okay. Next question. What is your favourite book and why?
But there are so many.
Okay, what's your favourite book about money? Book about finance?
Oh, good Lord. I might have to come back to... dear. You're going to have to edit this, because...
Yeah, that's fine. I wonder if we recorded... Oh, nice.
Favourite book? Wow. Gosh, can I come back to that one? Because honestly, I just...
Yeah, we can come back to it. Okay, what is the best piece of life advice you've ever received? Or just the most memorable? It's really stuck with you.
I think life is not a practice run. So life is today. The seconds tick by. You're obviously not getting any younger. You have to do what you want to do now, rather than think, oh well, I'll do it in 5 or 10 or 15 years' time. Well, you might not be alive in 10 or 15 years' time. So, as the Romans said, carpe diem, seize the moment, or seize the day.
Did you figure that one out yourself, or was that something someone told you?
Oh, I'm sure somebody's told me. I couldn't tell you who, but lots of people have told me.
Okay, so that's really stuck with you. Yeah. Okay, love it. Has the book one come back yet, or not yet?
Not yet. No, I'm still cogitating at the back.
Okay, if you could be 23 right now, in this day and era, whoa, crazy. You might have a TikTok account. I'm kidding. But you know everything you know now. But you're not in this position. You know, you're freshly graduated from uni maybe. You don't have much money. What would you do?
What would I do? Well, I mean, I've had a pretty good life. So, would I do anything differently? I think we are all products of the circumstances in which we were brought up and the environment that we lived in. So, I was brought up in the Cold War, gosh.
Okay, maybe what advice would you have for 23-year-olds then? Or if you could go back and speak to 23-year-olds. Okay.
I think people should do what they enjoy doing. So what you don't want to end up is 40 years down the road having done something for 40 years that actually you didn't really enjoy doing. There was a UK comedian called Ronnie Barker, who you may never have come across. In the 70s and early 80s, he was just a god. There was a show called The Two Ronnies, or something called Porridge, amongst others. He was very, very talented, and he retired and went off and ran I believe, an antique shop in, I think, Moreton in Marsh or somewhere like that, because that's what he'd always wanted to do.
Oh.
Unfortunately, he wasn't very good at it.
Oh.
What happened to the antique shop, I don't know, and this is only second-hand knowledge. But really, he should have stayed what he was doing what he was doing, because he was really good at it, and actually, he quite enjoyed it. But he really thought that he wanted to go and run this antique shop, which really didn't work. So my advice is to do what you want to do. It helps to be good at it. And if you're doing something that you enjoy, you're almost certainly going to be good at it because you're enjoying doing it, and you're going to spend more time or invest more time in doing it because that's what you enjoy doing. If you end up spending your life doing something you hate, that's probably not a great result. As it turns out, I've spent a lot of time doing things that I really quite enjoy.
Yeah.
So.
Yeah, there's no stopping you. Yeah, because, you could retire today, but I'm assuming it's because you enjoy it.
People have said it's sort of like playing chess and being paid to do so.
Wow.
In a funny sort of way.
Okay.
So that's not bad.
Okay, my last question is, what do you think about hard work / kind of having balance and living your life? I feel like, don't know if you're on the old Instagram or TikTok, but there's a lot of videos out there that will either show really work hustle culture, waking up at 5 a.m, going to bed at midnight, really working. And then there's other sides showing like, have balance, clock off at 5, have your weekends. What are your opinions on that? Do you believe in hard work or balance or both?
Okay. It depends what goals you've got for your life, but if you want to be seriously successful in the sort of the eyes of the world, i.e. money, you've got to have pretty serious focus. And so if you read the obituaries of very successful people, you will read between the lines and work out some things sort of went by the board, and really, gosh, I mean, people who are towers of their age, their children often don't get a great deal because they're off doing whatever they're doing, and their children are rather left to sort of fend for themselves, either with a nanny or with grandparents or whatever. So as an individual, I think you've got to work out what drives you. It's tricky because some people really, really, really do want to be successful, and thank goodness that is the case, because the world perhaps wouldn't progress the way it does if everybody wanted an evenly balanced life. But for most people, I think actually an evenly balanced life where you work hard, but actually you've got time to recognise your own children or your partner and your friends. Yes, friends are pretty important, and if you're so focused on driving towards that next materialistic goal that you've forgotten who your friends are, you possibly never had any in the first place. But so I think a balanced life has got a lot going for it.
Would you say you've had a balanced life?
I don't know if anybody else would say I had, but I think I have.
Okay. Why do people think you've had more of a work life?
I don't know. I mean, you know, we all have several different lives, don't we? We have a work life, we have a home life, we have a school life, and so you have friend groups who are in sort of different spheres, and there are overlaps in these spheres, but people know you as something in your day job, and perhaps they might not recognise you if they saw you out of your work environment, and vice versa. So I've been very lucky,
amazing.
and I still haven't answered the book
And
question.
you still haven't answered. You know what, we'll leave it on a cliffhanger. It'll come to you like 2 a.m.
Yeah, there's just so many.
Yeah, no, I can imagine. I'm sure you've read a lot. Okay, well, thank you so much for coming on and making the time. I know you're a busy man and you have a meeting soon, I think. But yes, thank you so much. I usually plug where people can find the guest, but I'm assuming you don't want to be found, or is there a place where people can learn more from you?
Fundology.
Fundology, the book by John Chatfeild-Roberts. I'll put it in the show notes. And that is everything. Thank you so much once again.
Well, thank you for asking me.
Of course. All right, guys, if you did enjoy this, feel free to share it around on social media and be sure to tag me. You can press follow or subscribe on whatever platform you're on, and leaving a review really helps this. Thank you, and I'll see you guys next week for another episode. Bye.